Hello, my name is Lachlan St. Clair and welcome to the April edition of Smart Money. Well, March has come and gone, and didn't that turn the world upside down on us? Share market, domestic share market in Australia off 26% plus, United States S&P 500 off 27%, cash rate in Australia down to 0.25%. Just extraordinary. Schools closed, kids being schooled at home by parents who are also trying to complete and juggle full-time jobs. Just an amazing world that we now live in at the moment. Clearly coronavirus has changed everything, and I suppose in this edition of Smart Money what I want to try to do is take you through some of the latest economic thinking in terms of where this thing is going to end and what needs to happen in order to try to recover from this as quickly as possible. What I'm going to share with you from an economic perspective is something that I got from Hamish Douglas, who runs Magellan. I seem to quote Hamish a lot, but he's probably the best communicator in the industry. And what I'm about to share with you is something that he developed in conjunction with his board, which includes people like Janet Yellen from the US Federal Reserve. Basically, the way Hamish looking at it is like this. You come along before the coronavirus hits and you have a certain level of output, and then the coronavirus hits, everything gets turned off, social distancing happens, people start going to pubs and restaurants and clubs and work shuts down and all the rest of it, and you get this massive reduction in output. Now, the question around how we recover out of this very much comes down to who is going to underwrite this output gap, this reduction in output from the pre-COVID position to the post-COVID position. And you've got a spectrum in terms of how you can do that. Right at the very far right-hand end, which is the end that we consider to give you the greatest prospects of V-shaped recovery. V-shaped recovery just means the market falls and comes back again really quickly. So that model, which I understand is something that Singapore is undertaking, is essentially where the government comes in and underwrites the output gap for industry, for all commercial businesses. So to replace your revenue, guarantee your earnings, businesses effectively continue on operating, just instead of the consumer handing over the check at the front desk or the cash, the government effectively does so. Everybody remains employed, the economy effectively just continues to truck along until the coronavirus and the social distancing, I should say, is lifted and the economy comes straight back up to meet it again. And the problem with that clearly is it's insanely expensive. It's going to cost the government a lot of money to underwrite that level of production to that degree. So it's obviously not something that's possible across the balance of the Western world. The next level down is when a government steps in and underwrites a component, say 40 or 50 or 60% or whatever the case may be. And this is sort of the model that Germany is going down. So instead of underwriting the entire output gap at an industrial level, they underwrite 50% of that output gap at an industrial level. And that should sort of create more, it won't be as fast a recovery because corporates still have to rebuild, but it will be a relatively quick recovery. It would be expected to be relatively U-shaped. The third model, which is really the model that Australia has gone down, is underwrite a little bit of the output gap at a corporate level, but really try to protect employees. So there's a whole lot of wage protection. People obviously lost their jobs, are entitled to some pretty significant benefits from the government. It's not the same as underwriting the industrial gap, underwriting businesses, but it is still material, and obviously from just a personal perspective, it's just protecting people and people's way of life. That is a slower recovery because corporates contain more damage or become more damaged, I suppose I should say, and therefore it takes them more time to recover back up again. The far side, or the sort of the depression sort of model, is where you just don't underwrite anything. You just let your economy take the fall effectively, and basically what that does is it will just destroy balance sheets across personal, across industry, across corporates, and you've really got to rebuild that from scratch up, and that would be an absolute disaster. Now, clearly, some countries can afford to do more than others. The Western world countries are going to have the ability to do quite a bit of this output underwriting, if I could put it that way, underwriting this output gap. However, clearly a lot of nations, particularly some of the poorer nations, are going to really struggle to underwrite any of the output gap, really, and they face probably a pretty difficult road ahead. So that's really sort of how we're thinking about the economic output at the moment. The reality is that nobody knows what's going to happen over the next couple of months. Nobody knows how long coronavirus is going to be with us for. Nobody knows how long we must participate in social distancing. And most importantly, nobody knows how long it is until we can turn the economy back on, basically, and turn aggregate demand back on. And in absence of knowing those things, it makes it very, very, very difficult to make a projection. Most people I see and speak to are sort of hoping for late Q2, so late sort of May, June, we'll start to come out of this stuff. Look, I hope they're right, but at the end of the day, it's based on hope. It's not based on anything else because there is no precedent for any of this sort of stuff. So obviously quite a difficult time. Attached down the bottom in the comments section, I've got a paper from Franklin Templeton, which I think sort of outlines some of this stuff really well. It's not Hamish's case, it's written from a slightly different perspective, but it is a nice plain English discussion around the issues that do face the economy at the moment. Okay, now on to what you can do. Obviously, when you come through these dips in the share market, every advisor is going to be telling you don't sell, don't sell, don't sell. And that's our advice as well. You can't sell into this sort of weakness. However, what can you do? I think the biggest thing, and we've been out to a number of our clients with regards to this, but the government has, as they did in the GFC, introduced a reduction to the minimum pension payments. So if your pension payment was 5% of your superannuation, the intention is to drop it down to 2.5% of your superannuation. So you don't need to take as much income out of your fund, and you also don't need to spend as much. Now, clearly expenditure for everybody is down because you can't really spend it on much anyway. You can't go out a huge amount at the moment. But clearly, if you can reduce your pension payment, then you increase the time with which your bucket one assets will last in order to fund that component of your pension and give yourself more time for the equity markets to recover. So if you have not been in contact with us about reducing your pension payment, please get in contact with us. Just drop us an email. We can talk you through what your opportunities are and the options, and we can make a decision and move forward from there. Also, of course, bear in mind, if you do make a choice and something changes, we can change this stuff again pretty quickly. So nothing's set in stone at all, but it is important that in times like this, what you can do is reduce your spending levels. And if you reduce those spending levels down, then you're going to increase the time with which your assets will last you. Now, just as a final note, I'd like to just take the time now to acknowledge my staff and the office at CSP. This disruption's affected everybody, and our office is no different. And I'd really like to thank my staff for the effort they've put in to make sure that our clients has had as much of a seamless experience as possible, whilst really dispersing ourselves back to our homes and moving ourselves to an online environment and a work from home environment. From what I understand from most clients, the experience has been pretty good. If we have made any small mistakes, please forgive us. We're just sort of finally feeling our way around around some of the more the finer issues. But I think in general we should have a pretty seamless experience going forward. Now, clearly we're coming up to Easter at the end of the week, so we trust everybody has a safe and just a safe Easter. I don't think anybody's going away, and we're certainly not either. After Easter, we'll be back on deck, and those clients who normally get their review between May and June will start to get the emails out for that review period. Clearly, that's all going to be via video conferencing, but the facilities we've got set up now are pretty good, and we can certainly talk you through how that happens when the time is right. In the meantime, of course, if you have any questions, you're always welcome to give the office a buzz. Otherwise, we look forward to talking to you all soon. Thank you very much.